Hey, everybody, we are going to talk about banks today, but not necessarily great news. We've seen some trouble in certain forms of credit. Banks are experiencing a little bit of losses, things like that. We're going to dive into it and what JPMorgan Chase's CEO, Jamie Dimon, had to say about it. Before we dive in, Tyler is joining me. Please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from the Motley Fool. It is the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Tyler, let's get right to it. Jamie Dimon, so far in earnings season, most bank CEOs have seemed very optimistic, but Jamie Dimon, he was pretty optimistic in most of his commentary. But there was one little tidbit that kind of caught your attention. And what exactly was it?
Yeah, I want to preface this a little bit because for people who have been following lending, banks, private assets, things like that, may have noticed there was a couple recent bankruptcies. Or is it First Brands? Oh crap! I should start over. Do you remember? Is it Finest Brands or First Brands?
I think it's First Brand.
First Brands. Okay. Yeah, let me preface this a little bit because for those who aren't following the lending market too closely, there has been a couple bankruptcies in the private asset market lately. Tricolor was a used auto dealer, and First Brands was an auto parts dealer that made like Fram oil filters and things like that. And basically, what happened was because these were private assets that had loans with non-bank lending institutions or non-bank financial institutions. And because of that, those institutions happen to have loans out from the big banks like JPMorgan. And so there was questions about Tricolor's bankruptcy and JPMorgan exposure to it because they took a write down related to that. And so there was some questions prompting about like underwriting in private assets and private credit and things like that. And it was of all of the very optimistic language that it was mentioned by bank CEOs this past quarter about M&A and IPOs and investment banking all looking fantastic. This kind of market commentary on the private asset credit market really stood out in contrast to everything. And that's why I kind of wanted to discuss it here, because he was really talking about like, we don't there's a lot of companies out there, and this was kind of his words, is like, we think some of their underwriting isn't great, and there might be some bad underlying loans that are happening at these non-bank lending institutions that could get into trouble. He was mentioning, it's like, yeah, we've seen some of their lending underwriting, and we don't think it's subpar compared to what we did. And even after our kind of mess up with Tricolor, you know, we think we're in pretty good shape, but we don't know what everyone else is doing. And you could view it in a couple of ways. Maybe he, yes, is genuinely voicing concern about the credit market in general, which could be very true. I can't confirm that 100%, but at the same time, it also just may be Jamie Dimon kind of talking up his own book a little bit, being like, yeah, we don't really know what's up with those other guys. Who knows what they're doing, but we're good. So don't worry about us too much. So, take whatever was mentioned there with the slightest grain of salt, that maybe this isn't just the doom and gloom, and it was just kind of a way of making JP Morgan look like the better bank. I mean, it's not really hard for them to do. They are obviously the biggest bank, at least in terms of market cap in the United States. So I think it's something to at least worth following, because private assets, private capital, private equity has become it's become much bigger even than a lot of the public markets these days. I think there's like 18,000 companies under private equity and private capital versus the 7,000 or so that are in public markets. So there is this kind of push right now, and there's a lot of things going on in the private markets that we just can't see because it is private market deals. And if some of the things that Jamie Dimon was saying about poor underwriting quality, if we were to go through a slower economic period or tighter credit period, a lot of these companies could be in trouble. And so it was something, at least in my view, as like, hey, of all the wonderful things that are going out there in bank world right now, maybe this is one of the things we should be keeping an eye on.
Yeah, and I mean, on one hand, I've been saying for a long time that the auto lending industry, especially subprime, is kind of a house of cards. You know, they're loaning, you know, 50, 60, $70,000 to people with, a 500 FICO score, and on a depreciating asset. And I mean, how could that go wrong? It's easier to get a car loan on a depreciating asset if you have bad credit than it is on a mortgage, which in worst case scenario, the bank can take it back and it's probably worth more. It's not a great industry right now. And on the other hand, you've also seen other banks like specifically Bank of America and Wells Fargo. Both of them have surprisingly lowered their provision for loan losses in the recent earnings, which kind of seems to be contradictory to what Jamie Dimon's saying, in that credit quality actually within their portfolios might be better than people thought. So it's something definitely to keep an eye on. I and as I mentioned at the top of the video, most of Jamie Dimon's commentary in the earnings call was very positive, which I think Tyler would agree to that as well. So it's something worth watching. I have a feeling it's more specific to that one, the auto industry, than anything else, but definitely worth keeping an eye on. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.